Welcome to QAV Australia, episode 908, 24th of February 2026. Yes, TK, I have a new look.
Very King's Cross.
Yeah, but no, but
It's boys' Mardi Gras week this week.
the thing is, Tony, when I put these glasses on, I start to talk like Michael Caine. I have to say, you're only supposed to blow the bloody doors off, Tony.
You do look like Michael. You do look like Michael Caine with those glasses.
That's why I bought the glasses, Tony,
Oh,
because I watched the IPCRES file and I said, I want some 60s glasses. Big Michael Caine 60s glasses. But I have to talk like this when I have these glasses on.
I get lots of clips from Michael Caine on my streams now. Interesting one last night. So, you know, he was born in an area called the Elephant and Castle after a pub called the Elephant and Castle.
I did not know that.
Yeah, and it's a Cockney area. But the history of that is that it's actually named after Charles, must be Charles II. What's Charles now? King Charles III? I don't know, the current king. The last king that was called Charles had a mistress who was nicknamed the Castili Infantati. And that's where the area was named after. But no one gave a damn about that, and they changed it from Castili Infantati to Elephant and Castle. That's why the pub is called the Elephant and Castle.
Right.
Named after the Charles II's mistress, who was Spanish.
Wow. I'm already getting slow upload messages from your end, Tony.
Well, you know, blame Elon because I'm using Starlink. It's telling me I'm good.
Damn it, Elon.
Yeah.
Well, Tony, got a lot to talk about this week. I have a lot of notes. It is reporting season. We didn't have a lot to buy last week. I did have about 7 or 8 stocks today when I ran a new buy list.
Yeah.
I think it was 4 yesterday, 5 or 6 today. Although one of them was Rex or Reg or something, but then when I went to check it, it was actually a Josephine, so had to scrap that. But it's starting to pick up, starting to get some reports out.
I'm finding that too. Not only are they volatile, but we're getting more numbers into Stock Doctor now. So, yeah, my buy list today was longer than what it has been for a while.
I'm going to start by, well, I'll start by doing a portfolio update. Let me do that. Portfolios have been going well. I did the light summary yesterday for the light group. For the last 30 days, it was only up about 1% versus the index up 2.5%. But the week before, I had said that the best stock in the light portfolios for the previous 30 days was Southern Cross Electrical Engineering, SXE. It was up 13% for the month. When I checked yesterday, it was still the best stock for the month, but it was up 42% for the month.
I'm guessing it had good results.
It did have good results. And for once, good results actually helped and didn't make it go down, as we often see. 42% when its results came out. And that we have 2 holdings of it, which were up respectively 318% and 340% since we've held them. So good job, Southern Cross. I don't know what you're doing, but good job. The light portfolio is up 40% for the last 12 months versus the index up 13. And since inception, it's up 22 versus 11.
Mm-hmm.
So that's doing all right. The dummy portfolio, let's have a look at that. For the last 30 days, the dummy portfolio is down 1% versus the index up 2%. Best return in the last 30 days in the dummy portfolio is PPM, Pepper Money. Are they being acquired or something at the moment? Isn't Challenger?
Well, they'll get a mention in my pulled pork today, yes.
Yeah. They're down a little bit, but they're up 15% in the last month as a result of that. But for the last 12 months, the dummy portfolio is up 30% versus 13% for the index. Oh my, that's crazy. This financial year, dummy portfolio is up 23% versus 8. And if I do sort of last 5 years, the dummy portfolio is up 16.5% versus 9.6. Not quite double. It's come down a little bit in the last month or so, but still doing
Oops.
okay. Hey, Tony. And what I hear from the members, everyone's portfolios are doing great. Everyone's happy. Happy little
Okay.
QAVers.
See ya. I'm off to the golf course.
Jordan has built a regression testing
Oh.
script, which he's been sending me all this stuff. And every time I try and read through it, it just gives me a headache. So I'm like, I'll put it off and do it later. And I never get around to it. I sent him an email this morning saying, look, sorry, I haven't got into this. It's just too much and too heavy and too deep. And I got too much other stuff on. And he sent me a great response. Hey, Cam, to be honest, I spent the last week making a ranking system using the data from the report and ran a test overnight, and it seemed to just produce market
Ooh.
returns. So at the moment, I've learned nothing, and it may just be noise. So far, pretty much all of the tests I have run produce QAV or worse results. I had one test that was 5% better CAGR than QAV, but I don't necessarily think this is repeatable in the real world and may have just been a quirk of the way it selected stocks. I need to investigate it further, but I'm not hopeful. I'll try to get around to writing a summary of what I found at some point and pass it over to you. I will summarize it. Tony's done a great job creating QAV, and it's really hard to find tweaks to improve it. Thanks, Jordan.
That's the old evolution beating science, is it? That it's evolved to be the optimal.
Well, I just think you have done a really good job. I mean, I said to him, I expect that we'll have super intelligent AI at some point, and I'll say, have a look at this, and it'll go, it's pretty good. Really, it's doing pretty good.
Yeah. I'm still trying to do regression testing for the growth over PE changes. So if there's a back testing that can help with that, that'd be great.
Well, I want to ask you
sorry,
go on.
Devoting an hour in here and there, but I'm really only getting through a couple of transactions each hour. So yeah, it's just really slow.
Wheat.
Australia's biggest grain crop.
I was having a look at the wheat commodity chart, the wheat sell line, and wasn't quite sure how to track it. Now, when I go into trading economics, it won't let me even open the bloody thing.
So we're looking at lines of wheat.
Wheat lines flowing through my mind, and all the while I think of you. You know that song? White
Is
Lines?
that?
Grandmaster Flash and the Furious Five?
No.
Come on, man. What?
I know of them. I just don't know that song.
White Lines? Classic. Duran Duran did a cover of it in the 80s, 90s, 2000s maybe. So if you look at the monthly thing for the wheat thing, the wheat chart.
You sound like Roddy.
Yeah.
I'm going to have a conversation with him. I have to request pronouns.
So the trough for wheat is December 2025, 507 USD a bushel, and then the line goes straight up from there to February 26 at 581. So, I mean, if I go back in time, typically what I'll do when I'm drawing my 3-point trend lines and my coding these days is if there's no easy line to draw, if the trough, the lowest trough is the most recent trough, and there's no easy second trough or even second month to draw a sell line through. You see, if you drew one from this, it would just go straight up the price line anyway, which is kind of pointless. If you go back in time and try and find a previous sell line, it's also difficult because the price has been coming down for the last few years. So I have had this down as a sell because I think it's been declining and it hasn't really broken through. When you have a look at this, how would you evaluate wheat?
The problem is I can't look at it. Like I'm getting a weekly graph. If I go to monthly, it asks me to log in.
Oh, right. Well, yeah. Let me.
So if I look at the weekly graph, there's a trough, as you said, but in in the following weeks there's a second sell line, so you can draw a line and it's above, the current price is above that, but we normally use monthly rather than weekly.
I'm going to share my screen with you so you
Oh,
can
okay.
see what I'm seeing.
Yep, good.
Can you see that?
Yeah, I can.
So that's the monthly chart. You can see this is the lowest point here,
Yes.
December. It just goes
Yeah.
straight up. It goes straight up from there. So it's picking up. It'd be
Mm-hmm.
above its byline if I draw a
Mm.
byline down here. But I struggle to draw a sell line for this. So I wanted to get
Mm.
your thoughts on it.
Um, yeah, good question. I think it's above its byline, so I'd say it's a buy, and I would treat it as being on its sell line, but not below it. But
You just draw the sell line straight up there.
yeah, yeah. But I also think it's a good question. I would,
Hmm.
because we've got an L1 but no L2, haven't we?
Unless we go back and do a retrospective
Yeah,
sell line, and then it's going to be, yeah, even
below
that's
it.
going to be difficult because you can't really draw one out of September 25 either or there. Like the troughs keep getting lower and lower all the way down here.
If you go
Maybe
back, you're going back to the
July
left hand.
24.
Yeah, okay. I was going to say even back to the left hand side of the graph before the peak.
Right.
Yeah, but
If I drew it from July 24, it might be above that, but you know, it would have breached it here. I don't know. It's kind of messy.
the way I do it is you've got L1, which is December 25. You've got a month after that, which
Yeah.
is kind of L2, and then you
Yeah.
draw
You
your
just draw it
line.
straight up. Yeah.
Yeah, yeah.
It's a bit of a Schrodinger, I think, kind of. It's sort of above the buy line, kind of below or on the sell line, but
Mm,
I'm not sure there's any wheat stocks on our buy list anyway that it matters. I just thought I'd
mm,
ask. All right,
yeah.
enough of that nonsense.
Hmm.
All right, well, kind of that. Um, what else have I got here? Where's my notes? Too many screens open.
Yeah, same. I'm closing all mine down, though, because of the drain
Yeah,
on the upload.
you're all pixelated-y.
Oh,
NWH, another good report. It jumped up. Everyone was happy about that. Parenti, on the other hand, came out with its results,
mm.
dropped at least 13%, might have been a little bit more than that. Did you have a look at the NWH or the PRN results in any detail?
Didn't look at NWH, but I own Parenti, so I had a look at them in detail. Interesting. I don't know what it's done today. Have you seen what the share price has done today? Because it
Yeah,
was down
continued
14%
continued to
yesterday.
drop
Has it really?
today. Yeah,
Okay.
233 it is today.
Okay. Okay. So my take on the profit was it wasn't too bad. So profit was up 12%. I think what people are focusing on is two things. Revenue was reasonably flat compared to the first half last year. They've done some good things. They've reduced their debt. They've increased their dividends. So the numbers aren't too bad. Um, I think what's happening is this business, even though it's known as a drilling services business in the mining sector, because it's done a lot of roll-ups with drilling companies, it's basically about 70% a contract miner at the moment. And so it's got these contracts to run and operate mines, and there's a few in South Africa. Oh, sorry, in West Africa. It's expanding into the US as well. It's got a couple in Australia, but they're largely locked in revenue. So there's not much, unless they pick up a new mine contract or lose a mine contract, there's not much change in revenue year on year. So that's what I think is happening, is that even though it's steady as she goes, the analysts are saying, well, where's the growth? The growth is in the drilling side, which continues to increase, but that's only about a quarter of the business now. So it's really got to increase a lot to move the dial. And then the other sort of 5 to 10% is mining tech services, which is also growing, but again, it's a very small part of the business, about 5%. The other thing that's hurting this company is that a lot of their contracts, because they're international, are done in US dollars, and the US dollar is dropping against the Australian dollar anyway. So when they repatriate income into Australia, they're losing a little bit because of the appreciating Australian dollar. Sounds like they're unhedged on that basis. So they did they did the conservative thing and they updated their guidance and dropped the top end a little bit, which I think has spooked the market, but hasn't spooked me because Parenti has got a history of under-promising and over-delivering. And so last year they said that FY26 revenue will be between 3.45 and 3.65 billion. And at the latest half results, they've updated that to be between 3.45 and 3.55 billion. So no change to the bottom and just a slight a decrease to the top because of their worry about this differential in the US dollar to Australian dollar conversion. And likewise with EBIT guidance, they've dropped it from a range of 335 to 355 million down to 335 to 350 million. So again, not much of a change to the range. And I don't know why analysts were factoring in the top end into their models anyway. You'd normally factor the median of that range into your models. But for some reason, people haven't liked that change to guidance and they've sold the stock. But look, everything else looks good to me. It's a cash-generating business. It's got long-term contracts to run mines. It's got the drilling business, which is surging. It's got the tech business, which is nascent. Even though they've forecast slight downgrades at the top end of revenue and EBITs, they're increasing free cash flow guidance from being 160 million to 170 million dollars in FY26. So I'm not seeing any big movements that would spook me. They've decreased debt, they've increased dividends, they've decreased capex a little bit. So they're actually called out their forecast a decrease in capex that was being forecast at $340 million spend, and now it's $325 million spend. So all of those things are going to help cash flow, operating cash flow and free cash flow. So I think it's still a good company with low debt and large cash flows. I'm continuing to hold it, and I'm going to watch for any contract mining wins, which seems to be the big things that move guidance for this company.
Okay, so you're not concerned? No gnashing of teeth?
No gnashing of teeth, as Dave Allen would say.
Dave Allen said gnashing of teeth?
Yeah, the old sketch where he pretends to be Reverend Paisley. I'll be a broadcasting old fast and there'll be gnashing of teeth.
Good old Dave Allen. My mum sends me a Dave Allen clip at least once every couple of months.
He's great.
Back to our childhood.
Mm-hmm.
The only other thing I had to talk about, Tony, was an AFR article I saw, The Hidden Cost of the Passive Investing Boom. Jonathan Shapiro. I know this is one of your favourite talking points. The size of the passive funds. He says, in tough times, active fund managers have to stick together, and that's precisely what a trio of the world's top funds are doing in this week in Sydney, Melbourne and Auckland. Bailey Gifford, MFS and Orbis, who oversee around $1.5 trillion of assets, it's nearly as big as your portfolio, are hosting their third joint gathering in 6 years to promote the virtues of active management. The theme of the Active Advantage Forum is titled Beyond the Benchmark and is taking place at a time and place where the benchmark is in danger of eating everything. For the past 10 years, stock pickers have lost the active versus passive debate as beating the market has proved challenging for the industry in aggregate. But in the past 5 years, Australia has become the land of the benchmark due to the Your Future, Your Super regime. The introduction of performance testing has meant the industry in aggregate has deemed it too risky to fall behind its targets, and so they've tethered hundreds of billions of dollars of capital to the appropriate share and bond indices. The virtues of low-cost index investing have well and truly been proven, and the introduction of performance tests to weed out underperforming superannuation funds has largely worked. But warnings are growing that this benchmark-driven industry is creating unintended consequences for the market and superannuation members. In short, nobody wants this. Not sure about this. They've weeded out underperforming superannuation funds. Every time I look at the rankings, they're all underperforming except 2 or 3. Don't know.
Well, they all have to have an offering now, which a default offering, which can be benchmarked against this MySuper
Right.
listing. So that it has resulted. I think I think from memory, the bottom 5% have to show how they can improve or be tossed, and close down or merge with somebody else.
Wow.
So it has achieved results at the bottom end. But yeah, even the active managers now, like as we said, they find it hard to beat the benchmark because basically they're trying to hug the benchmark, but like eke out 2 or 3% beats, and try and stay on their bad years 2 or 3% below, so they can hold on to funds. Because as we know from QAV history, it's if you want to not care about the benchmark and just care about making money, you'll have years where you've underperformed. You'll have a lot of years where you've outperformed, and over time you'll massively outperform. But if you're in the public space and you're having a bad year, you'll lose you'll have funds redemption. So that's the problem.
Yeah.
But we've created, for all the benefits of index investing and low-cost ETFs, they've created this monster where people won't ride out a bad half or a bad quarter for an active manager. They'll just take their money somewhere else.
Yeah.
And it's also, there are other unintended consequences going on, because there's a lot of people taking their money out of industry funds and retail funds, so large funds, and putting them into self-managed super fund portfolios, which they're managing themselves, which is good.
Yeah.
Unless they don't know what they're doing.
Yeah.
And then you have the First Guardian and Shield problems where they're listening to bad advice. And even though they were getting benchmark returns in a large fund, they've lost a lot of money by doing it themselves and listening to bad advice. So there are unintended consequences in what's going on too.
Share of Australian market cap, and goes over the last 10 years. Back in 2015, it looks like it was about 6.5%, 7%. Today, it looks like it's 19% is in passive funds. That's crazy in 10 years.
Yeah. And if it keeps growing at that rate, what happens? I mean, eventually, look, I guess you only need one active manager to set the price, don't you? To be able to say, I've just had these results announced, and therefore I'm going to buy BHP or sell BHP or Parenti or whatever. And then the passive funds follow as the index needs to rebalance. But, that person's being squeezed out of the market because they've had a bad half and people are redeeming, then who sets the price? Index funds can't set the price. All they can do is follow the price, follow momentum. So that's an issue. I suspect that, it'll write itself, that education will hopefully improve, that people will know they've got two choices, index or passive funding, in which case they get market returns and don't complain, and or go into active managers, but be aware of volatility. And you just have to shut your eyes when the manager you like has a quarter where they've underperformed.
Or the market splits between people in passive funds and QAV subscribers.
Yeah, well, I think that's exactly what should happen. But you know from our history that as soon as we have a bad half, people give us all sorts of excuses why they want to cease being a subscriber.
Even though we tell them every week when things aren't going well, just stick with the system, stick with the rules. It's okay.
Yep.
People still panic.
Exactly.
He finishes this thing by saying the free market purists might argue that the system will take care of itself. I should be doing this as Michael Caine. I don't know why I'm not. A Darwinian. I have to get into character. Only supposed to blow. Yeah, that's it. The free market purists might argue that the system will take care of itself, Tony. A Darwinian purge of the weakest activist managers will leave the strong ones to feast off the abundant opportunities created by heightened volatility and price agnostic passive investors. But then the question is whether super funds will find themselves on the wrong side of the trade. Some people, Tony, just want to see the world burn.
Yeah.
Master Wayne.
Well, if you're doing Michael, I was going to say, if you're doing Michael Wayne, that makes me Batman.
That tracks.
It's interesting, isn't it? I actually think what might happen is something like QAV, where if you're an active manager, you'll disappear from the public view, which is what happens in the US. You look at Renaissance Capital and people like that. They don't give a toss about retail shareholders. They'll just take their networks of people who know that they're a good investor and take their money and say, well, you can't redeem it for 5 years and give it to me and I'll give you 2 or 3 times back, your money in the future.
Like Buffett in the early days, Berkshire.
Correct. Yeah, exactly.
Give me your money.
That's how it'll work.
Then just don't talk to me for 10 years.
Yeah, and look, Bitcoin's a really good example of what might happen with passive investing in the stock market if it gets too big, and it may already be too big now. In that, if CommBank comes out with a bad result, but it's not that bad, but the shares go down 1%, and CommBank's the biggest share in the index, so all the passive followers have to sell CommBank to rebalance their portfolios by 1%, and that sell-off means CommBank's down 2%. It just becomes an amplification of the momentum in the market, and you'll get these wild swings that you can't explain because it's just passive investing having to follow the momentum, and it'll become an amplifying of both uptrends and downtrends, which is not good either.
And how does that impact QAV long term?
Gives us better buying opportunities.
Right.
Because just like now, as we've said with some fund managers, or a lot of fund managers who are tied to a mandate, I've got to be a value manager, I've got to be a growth manager, I've got to be an international manager, I've got to be a top 300 manager or whatever. They're boxed in. If they can't find opportunities, they've got to try and maximize what's available, which whenever someone's boxing against you with one hand tied behind the back, it creates an opportunity for us as investors to take the other side and benefit from it.
So I've been watching too much Paul Lynde on Hollywood Squares. Do you remember Paul Lynde?
I do, yeah.
I went through...
Oh, that's good. Go on, sorry.
So...
I was just going to make another King's Cross reference.
Well, after you said tied to a mandate, I had Paul Lynde in my head going, I got tied to a mandate once. Took me hours to get him to untie me. I was watching Bye Bye Birdie. So over the weekend, I watched Viva Las Vegas on SBS.
Mm-hmm.
And I was like, I haven't seen anything else that Anne Margaret did in the 60s. And Bye Bye Birdie's on SBS. So I'd never seen that, so I started watching it. No, it's terrible. But Paul Lynde...
I've never seen it.
Oh, it's terrible. But Paul Lynde is in it as her father. And I was saying to Chrissy, oh my God, Paul Lynde, I loved him in the 70s. And he did all these voices on animated shows, and he was Uncle Arthur and Bewitched, but he did It's the Wolf, and then I went and started watching It's the Wolf from the Chattanooga Cats, the animated show in the late 60s. And then I started watching clips of him on YouTube on Hollywood Squares, and they'd always, he always had this really quippy, answer to a question, always with a double entendre or something in there. And he was so quick and so funny. But then last night I was just talking like Paul Lynde for hours, like in between Michael Caine and Paul Lynde. I was possessed. Anyway, tied to a mandate. Yeah.
With your thick black glasses and your blonde hair.
That's right. Blonde. Wish it was blonde. One of the kids at Kung Fu the other day asked me if I dyed my hair. I said, why would I dye it white? What's the purpose would that serve? Anywho, stock poll of the week, Tony. Moving right along, you suggested that we do a stock poll of the week. A poll of the week.
Yes, I did. Yeah. I didn't see it in the email though. So you've done it.
I did it in the weekly email on Friday.
I missed it.
A total, a whole 5 people responded to it.
Well, they're the lucky first 5 winners.
You weren't even one. I said,
I didn't see it.
Which stock from our buy list this week do you think will be the best performer over the next 12 months? There were only 2 stocks in the buy list, so it was easy to pick which two, DSK and SRV. And DSK got 1 vote, SRV got 4. Scott commented, after today's podcast listening, how can I buy DSK? Because I was bagging on DSK. So there we go. So over the next 12 months, we'll see. There's no winners. It's anonymous. So you just get to know if you were a winner or not.
Is 12 months the right time period, or would you just do it for a week?
A week? What's the point of doing it for a week?
Well, it's just random.
Okay. Well.
And we get the results. We get the results back.
Yeah. You get to see who did the best over the last week. So let's see. DSK 1 week, DSK went from 98 cents to 97 cents. SRV went from 98 cents. No, sorry, didn't click on that. Went from $7.64 to $7.69.
Hey, SRV. So four of our subscribers got it right.
It's probably Scott that picked DSK after posting that to give himself an out.
Or 80% of our subscribers are smart.
Sorry, Scott. Don't know why Tony just threw you under the bus there, Scott. Back to Bye Bye Birdie. The crazy thing about Bye Bye Birdie, the whole plot of Bye Bye Birdie is based on Elvis going to Korea. It's all about a rock star they call Conrad Tiddy, who is like basically Elvis, and he is, been called up and he's going off to war, and then they come up with this promotional stunt on Ed Sullivan for him to kiss one girl from the fan club as a farewell present to all the girls. The film was made in, I think, 62, 63. The girl that the Elvis character kisses is Anne Margaret. The very next film Anne Margaret made was Viva Las Vegas with the real Elvis, and they ended up having an affair for a relationship for like a year, even though he had Priscilla installed at Graceland at the time, with Anne Margaret. So she went from playing in a film about a girl who gets a date with Elvis to actually dating Elvis the next year. So there you go. It was crazy. Enough of them.
Wouldn't be the first Hollywood romance, would it?
No, no.
On
But
set?
you look at the two of them in Viva Las Vegas and you're like, oh yeah, they were totally banging. Oh man.
Yeah.
Apparently, I read that they recorded 3 duets for that film. The Colonel would only let the film use 1 out of the 3 because she was too good, and he felt that she overpowered Elvis. She had more charisma than Elvis, and he was like, "Well, we can't have that. She's too good."
Mm.
Oh man, she is good in that film.
Incredible dancer.
Oh, incredible everything. Dancer, singer, so much personality. She was, oh man, bonkers. Anywho, that's it. What do you got?
Oh, it's hard to follow that up.
The stock pick of the week. Yeah, that was big. Yeah. Big news.
At least the result isn't that one of us gets to kiss the winner.
Well, with these glasses, Tony, you never know.
Yeah. I got a couple of things. So I spoke last week about Mag 7 stocks and how I couldn't find depreciation on their balance sheets, even though they were investing heavily in data centers and the chips that were required for AI.
Yeah.
And so I asked ChatGPT to look into it for me and tell me whereabouts to find it on their balance sheets. And it said there's no specific place for it, and that it was often spread across cost of goods, R&D, and admin expenses, and it wasn't explicitly being called out. So that's what I suspected, which is not good, transparent accounting. But the reason for raising it again now is it covers up one important fact, and that's that the Mag 7 stocks who are getting heavy into AI are no longer capital-light businesses, which is the reason why they've always traded so highly and on high PEs. They're capital-heavy businesses now, just like railroads and manufacturers. And I think when the market catches up with that, I expect them to re-rate down. So I don't see a bright future for those stocks at all. And they're hiding the fact that they're now no longer capital-light businesses, which is even worse. So
not really.
Once there's enough pressure on them to call it out as exactly what they're spending on CapEx and what it's costing to depreciate, I think there'll be a re-rating.
I mean, everyone knows that they're raising billions and hundreds of billions of dollars to build data centers out. It's not really a secret.
Yeah, but that's the classic CEO going, look at this, we're going to be number 1 in the AI field. Don't look at all the capital we're spending. Don't look at the fact that we're worse than a railroad now in terms of our ROE and, our future profit margins and all the rest of it. But we're going to be number 1 in the AI space.
Well, there's plenty of...
And eventually the market catches up with that.
There's plenty of talk about... I mean, people have been saying it's an AI bubble for like a year, and there's a lot of discussion about the fact that, ChatGPT, OpenAI is never going to be able to generate enough revenue to
Yeah.
make up for the amount of money that they're spending. And yeah, they just introduced ads recently into the free version of ChatGPT to try and create some sort of extra revenue coming in. But yeah, I mean, yeah, one of them's going to win.
Yeah, but I guess what I'm saying is that the win's got to happen before the market catches up with the bad financial profiles for these companies now.
Well, we know because we've seen this before. It only takes one hiccup
Mm,
for the whole house of
mm.
cards for everybody to come tumbling down, and then somebody survives and they turn it into a business, ideally. Although I think this time it's different, Tony. Oh, did you see the Alan Kohler thing that happened last week? The AI video of
The
Alan
AI,
Kohler?
yeah, he spoke about it on his on Your Money Weekly. Yeah.
Right. That was
Mm,
amazing. For people who
mm.
didn't see it, and I'm sure everyone did because it's big news, but somebody created an AI fake video of Alan Kohler and I think the CEO of the Commonwealth Bank
Matt Coman.
having a
Yeah.
fight, and the CEO getting up and storming off the set or something. And Alan Kohler, I saw him being interviewed about it on the ABC, and he said it was so realistic, even he couldn't tell that it wasn't really him in the
Mm,
video. That's where we're at with AI
mm.
fake videos now. So buckle up for election season, folks.
Yeah.
No one can tell what's real anymore.
Mm,
Fun, fun, fun.
exactly.
Mm.
Yeah. Anyway, so that was my Mag 7 gripe this week.
Mm-hmm.
One good result that came out for me, I own QBE in my portfolio, and it was up 8% of its results, and I think it's still going up, so that's good. And they announced more than a 20% lift in profit, which was better than the expectations, both on the top line and the bottom line. So premium income was growing, and investment returns had also improved. So that was good for
Good
them.
job, QBE.
Yeah,
Quibi.
insurance company. And the last thing I've got is a pulled pork on Challenger. Used to be called Challenger Financial. It's now just called Challenger.
Mm.
If you're ready for
I
that.
am ready for that. And be careful. I added it to a couple of portfolios this morning. So just,
Oh, well, it's actually Josephine. Should you have done
it
that?
wasn't when I added it this morning.
Oh,
It
okay.
is now, yeah. So
Okay. Yeah, because I looked at
the
it.
one I'm going to do in the American show, Bread Financial, was good on the weekend when I decided. And then I was just finishing my notes this morning, and it's down 6%. It's now a Josephine
Yeah.
as well. I was like, damn it. Anyway,
Yeah, so I thought I'd still do it. It's currently a Josephine, but that's because it's below its month-end close, and the month's going to roll around again soon, so it may not be a Josephine in a couple of weeks' time. So yeah, I'm just going to pull it apart. It's got new numbers into Stock Doctor, so it's one we can trust with recent numbers. And yeah, it's also the acquirer or potential acquirer of Pepper Money. So I did mention that a couple of weeks ago. So it's kind of timely, but it's back on our buy list for the first time in a long time. For those who don't know, Challenger is an annuities business. So basically, it helps retirees convert super balances into guaranteed income streams. It has around $130 billion funds under management, which it uses to secure the annuities that its customers buy. So it's got two major divisions. One is what they call the life division, which is the biggest of their divisions, and it's the one that sells these annuities to people. And then it invests the premium money into assets, and then it earns a spread between the annuity payment and what it earns from the investments it makes. And it generally keeps its investments to fairly stable type structures, so corporate bonds, debt, infrastructure debt, commercial property debt, private credit debt, that kind of thing. But they do run a small funds management division, and part of that's called Parenti Partners, and they own stakes in various boutique fund managers, and they earn management fees and performance fees from that. And the equity part of Challenger's done well over the last 12 months. It's just as basically, even if you had an index fund over the last 12 months, you would have done pretty well. It's been a good year. But it's had a long history of doing this, so it's quite good at it. It's got a very dominant market position, and it's really getting some tailwinds because of the baby boomers who are retiring. So we have an aging population and there are massive super balances moving into the retirement phase now. So a lot of people are looking for certainty in their retirement, and they're happy to not get the best returns, but to trade that off for getting guaranteed payments each month. Um, Challenger has put their toe into overseas markets, because obviously Australia isn't the only country with an aging population, and they've expanded into Japan. And one thing that has happened in the last little while is a Japanese life insurer called Dai-ichi Life, which owns Tower Insurance, a company that's been on our buy list in the past too, TAL, T-A-L, New Zealand life insurer. They bought 15% of Challenger probably in the last 6 months. So, but more about that later. Another thing to highlight while I'm talking about the company generally is that interest rates are very important for this company. So when interest rates are going up, it's good for them. And of course, we just had a rate rise in Australia recently. So it's heading into a good period for Challenger. And that's because they'll get more from their investments. So bond yields will go up as interest rates rise. And anything that's tied to that kind of bond rate, like infrastructure debt, for example, will go up as well. And but they won't necessarily increase the annuities by the same sort of amount, so they get a spread increase in their margins. And why is that important? Well, it's important now because they're making more money, but it's also important in reverse. So they struggled when interest rates were very low. So sort of the 10 years prior to, say, 2023, they were struggling because interest rate cuts were squeezing their margins. It's important to point out they're not a bank, and they're not a traditional fund manager, and they're not even a life insurer. So it's a bit of a hybrid of all three of those. And it's kind of interesting to think about their business model this way. They're a life insurance business in reverse. So if you're a life insurance business, you take premiums from your customers every month or every year, and then you invest them. And when the person dies or reaches the end of the policy, they get a lump sum payout in return. And your job as an insurer is to work out how long the pool of people paying premiums is going to live for, and how much you have to get with your investments, both to have capital at the end to pay them out and to make a profit on the investments along the way. This is the reverse of that. So basically, Challenger takes a lump sum from the customer and then pays them back a dividend each month of an agreed amount, like a premium in reverse. And then Challenger invests the lump sum payment from the customer in order to be able to guarantee the provision of the payments for whatever the period of the annuity is. And sometimes they're open-ended. They'll just be a lifetime annuity. And oftentimes they're also time limited. So it could be a 10-month or a 10-year or a 20-year annuity product. So it's interesting to think about it in reverse. Very colourful history for this company. Founded in 1985 by a chap called Bill Ireland, and I'll talk more about Bill in a minute. But it floated on the stock market soon after that with a market cap of $800,000. Grew pretty quickly from there, and a couple of years later, well, actually probably 10 years later, in 1998, Kerry Packer and James Packer bought into Challenger. And that was important, not just because of the money, but because it gave the company legitimacy and profile. And then a little bit later, the Packers actually folded their investment vehicle, CPH, which was short for Consolidated Press Holdings, into Challenger in 2003, because they were both essentially funds management businesses. And they turfed out Bill Ireland at the time. And there was a couple of issues I'll talk about in a minute in terms of whether the accounting was right for the back-to-back investments for the annuities. And they expanded Challenger from there. But in 2009, the Packers CPH sold out, and then other people bought in. They also expanded into acquiring a banking unit called My Life, My Finance. And they renamed that unit Challenger Bank, which they then sold in 2024 to Heartland Bank. Along the way, Apollo Global Management, a big equity investment firm from overseas, from New York, came and invested in Challenger, and via an insurance affiliate called Athene, and they acquired 18% in Challenger. But they sold half its stake in 2024 back to Challenger. And in 2025, as I said before, Japanese life insurer Dai-ichi Life via Tower bought 15% of Challenger, and they now hold 19.9% of Challenger. And there's been a lot of speculation when that happened that Daiichi may well launch a takeover bid for Challenger, but they haven't done anything yet, and that happened last year. Getting back to Bill Ireland, he was a stockbroker, and he got, I'm reading from an article that occurred in the Sydney Morning Herald back in November 2006. It was by Lucinda Schmidt, and it says that Ireland was bored with relatively flat markets after the 1974 oil crisis. So he left broking, and he set up a couple of art galleries and ran them. One was called the Sydney Art Exchange, another one was called the Melbourne Art Exchange. And in those days, gallery owners were charging commissions of about 1/3 to sell a painting, but Ireland decided not to charge a commission. Instead, the art owners paid him 3% of the painting's value to exhibit it for a month and then put it up for sale. I don't know how that went, but after he finished with those, he then went into hotel development, and he had already owned the family he came from had owned the Randwick pub, and he developed that into a 140-room hotel, which he still owns, back in 2006 anyway. And then in 1986, he launched Challenger, initially to raise funds for more hotel developments. But he listed the company about a week before the October 1987 share market crash, or 10 days, it says, sorry, in the article. So his share price dropped a lot, and a lot of his plans were scuppered. He steered the company towards what he knew best after that, which was financial services, coming from the stockbroking industry. He built a reputation as an innovator, and he put together lots of different innovative deals, oftentimes buying assets and then packaging them up into a bundle and then selling those back into the funds management industry and taking a margin on the deal, things like pipelines, for example. But he also did innovative things like he put together a $300 million deal for Solomon Lew to sell his Coles Myer shares but retain the right to buy them back. So this is back in the sort of era before options were a big market in Australia. In 2003, as I said before, Kerry Packer bought into Challenger, and it wasn't long after that Ireland left and set up another business to compete head-to-head with Challenger in that kind of innovative funds management area. And that business was called Mariner Financial, and that was kind of style of Macquarie Bank or Babcock and Brown. So that's the Bill Ireland story. I will come back to him a little bit in this next article, which references him, and it references why he left Challenger in the first place. But this is a more recent article from the Financial Review. I'm just trying to find the author. I think it was Tony Boyd. Yes, Tony Boyd, in September 28th last year. Challenger primed for Japanese takeover. Daiichi Life's move on Challenger is perfectly timed to ride the tailwinds from regulatory relief and an aging population, switching from accumulating super assets to guaranteed income streams. The article says positivity about Challenger's prospects can be sheeted home to two events: Japanese life insurer Daiichi Life buying a 19.9% stake, and the Australian Prudential Regulation Authority signalling it will provide capital relief for annuities. So it goes on to talk about how Daiichi bought Challenger through its Australian arm, Tower Life Insurance. And it says Daiichi's entry into the Challenger share registry elicited a strong sense of deja vu among those who watched the Japanese life insurer take over Tower Australia 14 years ago. It was 2008, in the middle of the global financial crisis, that Daiichi Life first joined the Tower share register with the purchase of a 29% stake from the corporate raider Guinness Peak Group. That was later used as the platform for a full takeover in 2011 at a 46.5% premium to the last closing price. The Japanese executive and then Tower Australia director who orchestrated that $1.76 billion deal Tetsuya Kikuta is now president of Dai-ichi Life. He is implementing an ambitious international growth strategy with the goal of lifting foreign earnings threefold to 300 billion yen, about $3 billion Australian, by 2030. There are high expectations among bankers and investors that Dai-ichi, which is advised by Bank of America Merrill Lynch, will at some point proceed to a full takeover of Challenger. One sign of Dai-ichi's intentions is the decision by Tower not to appoint a director to the Challenger board of directors. The Japanese obviously want the M&A optionality that goes with not being an insider. But any takeover deal is likely to be put on hold until there is a clarity about the extent of the capital relief for annuities, due to be announced by APRA before the end of the year. Well, it hasn't been. I checked on that. It's underway, and they said they would announce by the end of the year, but APRA hasn't announced yet, but it's probably likely. UBS has an analyst called Kieran Chigi, and he reckons that APRA's revisions to the illiquidity premium for assets backing annuities could free up an initial amount of $400 to $600 million for Challenger. He says in a note to clients that the release of common equity Tier 1 capital could grow to more than $1 billion, which if directed into buybacks could lift earnings 8 to 12%, dividends 10 to 30%, and ROE to 13 to 14% from the current 11.6%. The market in Challenger shares may have got ahead of itself, given that APRA has for a very long time had a cautious attitude towards Challenger and its approach to matching assets and liabilities. This regulatory mindset started in the late 1990s and early 2000s, when Challenger International Chief Executive and founder Bill Ireland adopted an aggressive approach to managing the commercial property assets backing Challenger's annuities. Ireland not only loaded the Challenger Life balance sheet with highly leveraged liquid property investments, he used an unusual technique to pump up the value of these assets. Ireland divided property assets into capital and income units, and then used discounted cash flows to boost the value of the income units. This often resulted in the combined value of the capital income units being worth more than the property underlying them. Also, it meant that a portion of the annuities written by Challenger did not have long-term assets matching the long-term liabilities. This accounting methodology came to a screaming halt in 2003 when media mogul Kerry Packer stepped in with a $400 million recapitalisation, at the same time as he merged CPH Investment Corp with Challenger International. Under Packer, Challenger modified the valuation basis associated with the debt and property portfolio from a forward-looking income and capital unit assessment to the current market value of the property and debt. This triggered a $436 million write-down in Challenger Life's property and debt portfolios. The write-down was about equal to the sum of the previous 3 years of profits. Not surprisingly, Ireland left the business and Packer got rid of Challenger International auditors PwC and replaced them with Ernst & Young, who have held the job ever since. Over the past 22 years, Challenger has slowly but surely transitioned the life company's assets to a far less aggressive stance, a move that should have helped ease APRA's concerns about asset liability matching. Nevertheless, Challenger's monopoly control of the Australian annuities market means APRA has a good reason to tread carefully as it reforms the capital requirements for annuities. Challenger sells about 97% of all annuities in Australia. So that's Tony Boyd writing in the AFR about the history of Challenger and about where it sits now. And it's on the precipice of having some capital requirements freed up. Seems like the reason behind that freeing up is that when Apollo management sat on the register of this company, they raised the fact that the APRA rules were the most stringent, or among the most stringent in the world, and much stronger in their capital requirements than overseas markets where Apollo operated. And so that's one of the reasons why APRA decided to hold a review and take submissions. But there's also that it's a double-edged sword, because it will benefit Challenger if APRA reduce the amount of capital that Challenger has to hold to back the annuities. But it will also potentially invite foreign life insurers to enter the market and compete with Challenger, which they've resisted now for a while because APRA has had more stringent requirements than where they operate in their home market. So it could be a double-edged sword. The I guess to explain what APRA is looking at and what they're doing is um, APRA is consulting on a proposal to reduce prudential capital requirements for life insurers offering annuity products. That's the headline. They want to make annuities cheaper to provide, and therefore encourage more of Australia's aging population to actually take out annuities, because it's a guaranteed income source as opposed to being invested by super funds, which may go up and down over time. So there's I guess a positive societal benefit that APRA is looking at. That's why it's another reason why it's reviewing it. What APRA will probably do is talk about the discount rate that has to be held for various different types of investments. And so how's that going to help a company like Challenger? Well, the discount rate drives what type of investment is made and in what kind of asset and for how long. And if you think about it this way, if Challenger puts all its money into, say, 10-year bonds, it'll make whatever the bond rate is. But in 10 years' time, the real value of that money will be affected by inflation. So they have to discount the value of the money they've invested into 10-year government bonds by a hurdle rate, by a discount rate, which will be something like inflation. There's probably a little bit more than that put into the discount rate on the off chance that the government bond isn't repaid or something happens and it can't be repaid or it's extended or whatever. But it's basically being discounted by inflation. If the sort of further up the risk curve they go, and I guess equities would be the most volatile investment they can get into, the hurdle rate has to improve because if you put the same amount as you're putting in government bonds into the share market, even if it's a passive index fund, in 10 years' time, it'll be affected by inflation, but it could also, because of volatility, potentially be worth less than what you invested. It could be worth a lot more, but it could also be worth less. So the hurdle rate's higher. So given that Challenger now has a track record of saying we can invest in very predictable fixed investments over long time frames and then back-to-back that with annuities and make a margin, APRA will be sympathetic, I think, to allow them to have a lower hurdle rate on those investments. And that will boost, it'll free up capital and it will boost returns at Challenger. So that's what's happening in a nutshell with the APRA review. Hasn't been announced yet what it will be, if there'll be any change at all, but it's got to be put down as a risk that APRA may come out and not change the rules, in which case there'll be a sell-off in Challenger's shares because people are already putting the expected discount in capital requirements into the Challenger stock price valuations, and that'll be reversed if APRA does come out with something different. So we'll wait and see on that one. And then the last thing to talk about is that there was another article, again from Jonathan Shapiro in the AFR on February 17th, so what's that, 17 days ago, about why Challenger is interested in buying Pepper Money, which was on our buy list for a long time, number one on the buy list for a long time. Pepper's in the business of providing loans to SMEs for equipment or asset financing, and even personal loans to consumers. And apparently, according to this article, Challenger has been a provider or has lent to Pepper the bonds, the money then to go and sell to SME or go and loan to SMEs or private clients. So Challenger make a margin on doing that with Pepper, and then Pepper making a margin on that and doing it with their clients. So if Challenger takes over Pepper, they get some vertical integration, but they're also helping to secure that market in case Pepper starts sourcing their loans from somewhere else. So that's what's behind Challenger doing that. But again, this is a source of fixed asset term, term limited or term controlled loans, which are important to the investments for Challenger to then be able to offer the annuities to customers. So that's basically the company in a nutshell. Its results were good. They announced that they were going to do a buyback this year of up to $150 million worth of shares. Net profit was up. Earnings per share was only up 2%, a little bit. There's a few reasons for that, but there's a normalization that they do in their accounting to smooth out returns, etc. Dividend was up 7%. So even though APRA haven't yet released the results of their review, Challenger's had a good year. QAV numbers look good. So it's a large ADT stock. There's roughly $10.5 million traded every day on average. So that's will suit investors listening. I'm using a share price for my analysis at 9.24. I think it's a little bit lower than that today. But anyway, 9.24 is what I'm using. That's 6% below consensus target, but it's above our IV1 of 324 and IV2 of 666. So it's not trading close to our valuations, but it is trading on a low prop cap multiple, which I'll get to. Yield is currently 3.3%, which is good, but not strong enough for us to give it a tick. Stock Doctor financial health and trend is strong and steady. And Stock Doctor rate this is a quality stock and a quality income stock. So we give it a couple of extra ticks in the buy list because of that. Stockopedia F score is 6 out of 9, which is okay. Quality rank is only 66, which was okay, but not great. But the overall rank is 95 out of 100. So it's up there in terms of its momentum and value from a Stockopedia point of view. P is 14.6 times, which just sneaks in below the highest in the last 3 years. So that may well cycle in the next half to being outside of the range for scoring. But we give it a score of 0 anyway. It's in the middle of the range at the moment, or at least not above the highest or below the lowest. Prop cap is 3.38 times, and that's the real driver of our scoring for this company. That's very good. From a cash flow point of view. Net equity per share is $5.96, so we can't buy it for book or book plus 30 because the share price is $9.24. Earnings per share forecast growth is only 4%, so we can't score it for growth over PE, which only gives it a score of 0.25, and we want 1.5, so it's well below that. But again, if APRA come out with, I guess the flip side of APRA coming out with a lower than expected announcement is they could come out with a better than expected announcement, in which case the forecast earnings per share growth will soar. So it's fairly dynamic, I think, at this stage until APRA releases the results of its inquiry. There's no owner founder. As I said before, Bill Ireland's gone. The Packers have gone. It now has Daiichi is a large 19.9% or 19.5% shareholder as a cornerstone shareholder, but no owner founder. Can't score it for that. Overall, we give you the quality score of 8.5 out of 15 or 57%. So not great. And a QAV score of 0.17. So that's kind of middle of our buy list. Obvious positives for this is if APRA comes out with what's expected or better than expected and reduces the hurdle rates for the way that the investments are valued, and that means that they can free up capital, but still satisfy APRA that they're going to have money to pay out the annuities over time. There's obviously an aging population, a bit of a bump in the bell curve as people move from accumulation phase in super to retirement phase. That's a real tailwind for this business, and it's got a very very high, almost monopoly market share for annuities in Australia, which may change if APRA loosen the rules, there might be more competition. I think a big positive for this company is that it could be taken over by Daiichi/TEL, and I suspect Daiichi is waiting to see what happens with APRA because it'll just make Challenger more attractive to them if APRA comes out and loosens those hurdle rates. Challenger has been around for 40 odd years. It has huge relationships in the industries with intermediaries, financial planning groups, and the platforms, and the super funds, etc. So it's a very large moat around this industry, which it's pioneered in Australia and now dominates. On the risk side of things, the business is very sensitive to interest rates. So we saw that in the past where it had headwinds when interest rates were low. It's sensitive to credit markets. So if there's any sort of lockup in the credit markets for whatever reason, like there was in the GFC, that will hurt the business. It could blow up some of its investments. If it does have investment losses, then it's got to probably raise capital to meet its regulatory requirements to pay out the remaining annuities. So yeah, there's a lot of risks associated with this, but I guess it's still around after 40 years, and it now has experience with going through things like COVID and the GFC to know how to manage those risks. So it should have learned something along the way. Um, yeah, so it, I think it tends towards the upside. It's on our buy list. It's trading at 3 times prop calf, and it's a potential takeover target. So it kind of fits it's right in the crosshairs for us as QAV investors.
Well, from your lips to Elvis's ears, Tony.
Is Elvis God, is he?
Pretty much, yeah, I think so.
Yeah.
Yeah. If, like, I tell you what, if God is better than Elvis, he needs to show me something because Elvis laid down the original track. So CGF acquiring and might be the acquired.
Yes.
An
Correct.
acquisition domino theory. Thank you for that, Tony. Good to have a stock that you can talk about. No, we didn't have to make up one this week, like I thought we were going to have to.
Yeah.
Somebody we might have to sell by the looks of it. Macmillan Shakespeare. Shakespeare's ancestors. They own all the rights to all the Shakespeare stories, all the Hollywood movies. No, that's not true. What do they do? Leasing, I think, don't they?
Leasing, yeah, car leasing and packaging for salary sacrifice.
Came out with their half-year report. Shares dropped by 5.25% today. They're now a 3-point trend line. Sell if you hold them, as I do in a couple of portfolios. Quick analysis from Gemini on their report. Despite reporting top-line growth, they dropped primarily because key earnings and dividend figures missed the market expectations. Main drivers behind the sell-off were earnings miss, while revenue beat estimates by 4%. The underlying net profit after tax and amortization of $50.3 million was 7% below market expectations. They announced an interim dividend of 62 cents per share, which was significantly lower than the anticipated 74 cents. They had an EBITDA shortfall, was a 5% miss against analyst estimates, etc., etc. So there you go.
It's interesting, isn't it? Like if they know what the analyst estimates are and they're not going to meet them, why didn't they come out in reporting season and try and lower the expectations? Sorry, in confession season. Yeah.
Because that's a thing of the past, Tony. That's old-fashioned confession season. No one does it anymore.
They're all lapsed. They're no longer going to confession.
Yes. Well, speaking of confession, Trump had to confess to SCOTUS this week that he had somehow, I'm not sure how this happened, but his tariffs that he implemented were illegal and unconstitutional. Just missed that.
Yeah.
Missed that. They did have a meeting scheduled to review the legality of it before he did it, but just, no one turned up to the meeting.
Well, he's got the best Supreme Court money can buy, so it's kind of surprising they turned
It is
on
very surprising. Did you read anything about the company that took the case to the Supreme Court?
Oh, vaguely. I'm testing my memory now.
It's a relatively small family-owned business called Learning Resources, Inc.
Mm-hmm.
And they basically make like educational toys, stuff that you buy in like one of those shops where they have clever toys for kids to learn with, that kind of stuff. Of course, they get it all made in China, in places like that. And it was going to push up their costs by something like 44% or something like that. And they were a small business. No, 44-fold, not 44%, 44-fold.
Oh,
The tariff costs.
wow.
No, the tariff costs that
would-
increased
that
44-fold.
Oh, okay,
Yeah,
gotcha.
not their
Yeah.
overall costs.
Yeah.
But they took the argument that that small to medium businesses didn't have the capital to front run the tariffs or to
Right.
relocate manufacturing quickly,
Mm.
unlike bigger businesses. And Trump said he knows these people and they're all sleazebags and unpatriotic.
Because they're providing educational toys to
Yeah.
kids.
Yeah.
Yeah.
And now listen,
And Trump doesn't want that.
when Trump calls you a sleazebag, when the guy who was found guilty of sexual assault calls you a sleazebag, you know you got problems. Anyway,
There's been some great grabs in the news recently, hasn't there? There was someone in the Trump cabinet that was caught up in the Epstein files, and Trump said something like, he went to the island with his family, and yeah, so of course he went there, but that was okay. I've never been there.
yeah.
And the other one, my favourite was the British tabloids. I love their headline. So there was a picture of what's his name now, Andrew Mountbatten Windsor, in the back of a cop car, and the headline was, "Who's sweating now?"
Well, the best one was Les Wexner's deposition and his lawyer. Did you see that one?
No.
Billionaire Les Wexner, who owns Victoria's Secret and Abercrombie and Fitch and was one of Epstein's main guys, been very heavily connected with Epstein for decades. He was giving like a 5-hour long deposition to the House Oversight and Government Reform Committee about Epstein. And at one point, his lawyer leaned over to him and whispered in his ear, but was caught on mic saying, "I will effing kill you if you answer another question with more than 5 words, okay?" Wow. Good times in America. Absolutely bonkers times.
Oh, and the fact that the Supreme Court has now called those tariffs illegal or unconstitutional or whatever. Is BHP going to raise a invoice for all the tariffs they've paid that they didn't have to pay to the US and get them back? Is every other country in the world going to do?
Well, the countries didn't pay the tariffs.
The companies in the countries, yeah.
American businesses in America had
true.
to pay the tariffs.
True.
So there's like
they should, yeah,
$260 billion in tariffs collected, which in theory the United States government needs to pay back now to tens of thousands, hundreds of thousands of businesses, and which create
and the end consumer, because it's really the end consumer who pays the tariff. The businesses have paid it on the way through.
Yeah.
But yeah.
So how do they refund the consumers now?
Yeah.
And so then he immediately pivoted and placed a new 15% global tariff on everyone. So Australia's tariffs has just gone up from 10% to 15%.
Yeah. Happy days.
Yeah.
Doesn't change the fact the old tariffs were illegal and people have paid money what they shouldn't have.
And the EU has said, no, we're not renegotiating. Go to hell. That's it. We're done. Oh, man. It's absolutely bonkers. Anyway, the impact that all that will have on the stock market over there and by implication here, who knows? It's Cowboy City. It's the Wild Wild West.
Yeah. It's like, but if you're running a grift, don't be incompetent about it. So you have to drop it and start again. It's kind of an obvious tell, isn't it?
But I'm sure somebody, before they implemented this, I know he doesn't really have the sharpest knives in the drawer in his cabinet, but surely somebody said, excuse me, Mr. President, we sure this is legal? Don't worry about it. Don't worry about it. It'll be fine.
Everybody.
Don't worry about it.
Everybody said that. Everybody said that. It was all over the Wall Street Journal. These tariffs are unconstitutional.
Don't worry about it. It'll be fine. Be fine. As you said, got the best Supreme Court money can buy. Oh, dear. Anyway, after hours, Tony, what you got?
Have you seen One Battle After Another yet?
I have not. I want to see it. I've heard it's good.
Great.
Yeah?
Yeah, really good. Yeah, I watched it on the weekend. It's on HBO Max, I think. That's where I saw it anyway. Probably rent it in other places. So good. It's Leo DiCaprio. He's great in it. Benicio del Toro. Talk about God. He is God. You'll love it. He plays sensei. He runs a martial arts dojo and an underground, what do they call them? The tunnels, well, not tunnels, underground.
Rat lines?
Yeah. helping illegal aliens to migrate. Yeah. He's great. Really good.
He's always great.
Yeah, fantastic cast. Sean Penn is just amazing in it, playing an American colonel called Lockjaw. Like, they've all got names that reflect what they are, what their characters are. Yeah. Oh, it's so good. Really good.
Yeah, but looking forward to it. I mean, Hunter saw the premiere and told me it was really good. Yeah, but looking forward to seeing it.
Yeah.
No, I've been listening to Punk Klezmer. I put it in my light. Did you see the video? I put it in my light thing yesterday. Gogol Bordello, Ukrainian American punk kind of klezmer. So a lot of piano, accordion, violin, but sort of
Right.
Russian or Ukrainian accented punk. Check out their track American Wedding. It's pretty good.
I'll look at it. I've been traveling, so I haven't had a chance to go through my emails in the last day or so.
Where have you been?
Sydney. You flew up on Sunday. Oh, so Ruddy was staying with me for a week, and then he was flying back to Wagga yesterday. Oh, sorry, Sunday at midday. So I timed my flight to Sydney at midday as well. And I had meetings all day yesterday at Climb and then flew back last night. But so it was just one trip up to the airport. I land in Sydney at 1:30, get a text from Ruddy. The plane to Wagga Wagga has mechanical problems. They put me on a bus. He's probably still going back to Wagga Wagga.
Oh,
By
wow.
bus, the poor guy. Yeah.
Oh, that's horrible.
Good on you, Qantas. Yeah.
Wow. All right. Well, that's it for QAV this week. Things are going great. Just remember that for those of you that are basking in the glory of everything going well.
Yeah. It is just one battle after another, isn't it, really?
Well, yeah, but it's really not. Like, I don't know how to get this through to people. Like, just follow the system and it'll all come good. You know, at least it has in the past. What does it always say?
Yep.
Past performance doesn't predict future returns or something.
Well, it has for the last 6 years of QAV and the last 20 years of my investing, 25 years. Plus.
Yeah. Look, there's no guarantee that
No.
value investing will always work, but so far so good. You know,
it's no guarantee of anything. I mean, Roddy and I were talking about this when we were kids. It was all, we're going to be hit with nuclear weapons from Russia, and then it was the ozone layer is going to go away, and we're all going to fry, and then it was something else and something else and something else, and now it's AI, and it's just like, you just turn off the noise, don't you? I mean, yeah, we could be bugs to superintelligence pretty quickly. What can you do about it? You can't do a damn thing. So in the meantime, just keep doing what works.
Just keep putting one foot after another and, wait till things change and then adapt like cockroaches. Yeah. Like, I do believe that AI and robotics are going to have massive implications for socioeconomics in the next couple of years and then certainly over the next decade. But there are at least 10 different ways it could play out. I don't know which one it's going to take. So, All right, TK, let's go talk America. Thank you, everyone. Have fun.